In order to understand any situation thoroughly, it's always helpful to look at it from different angles. For example, losing weight is something that most people have been challenged with at some point in their lives. It's not uncommon for people on a diet to pull out their before photo and show you how far they've come since they began their program. Many people will also eagerly pull out their goal photo or the after photo. Ever done that? These photos are a source of motivation because they show you where you've come from, where you are currently, and where you're going. Anyone on a diet has a plan that involves increasing certain things like exercise and decreasing others like sugar. Business is no different. There are adjustments along the way that must be made in order to ensure that you remain in business and that it grows into a profitable company. These adjustments become very difficult and even impossible to make if you do not have the correct information available to make them. Financial statements merely represent the activities of your business in a way that will help you make informed and accurate decisions. Because entrepreneurs are often not familiar with the confusing accounting terminology, it's often a surprise to them when they find out that the words financial statements don't refer to 20 different reports or a thick stack of reports, but actually 3 documents. These 3 documents show you a picture of the past, of the present, and of the future state of your business. As you become more confident in reading these, you'll be able to get an objective view of your finances within your business. In the same way as the dieter has before, during, and after photos to better understand their weight loss progress, the entrepreneur can use these 3 documents to better understand their business progress, which assists them to make intelligent and informed decisions. Have you ever been in a situation where you hear people talking about financial statements, financials, management accounts, management financials, annual financials, and you stand hoping no one asks you anything because they are terms that are totally alien to you? You're not alone. Many entrepreneurs who are starting out feel like there are hundreds of documents out there that they should know about, but don't. Just like the words napkin and serviette refer to the same object, so do the phrases financial statements, financials, management accounts, management financials, and annual financials. Broadly, all refer to these same 3 documents. It's vital for you as a promising entrepreneur to remember this, so that when you're speaking to your bank manager or prospective investor, you're not intimidated. What will be helpful is to remember that although these terms are intimidating and can cause even the most confident entrepreneur to want to run and hide, they serve exactly the same function as the before, during, and after photos of a person on the weight loss program. In this module, we'll begin taking those small steps by covering at a very basic level what each component looks like and what it's used for. You'll find that there'll be specific times when you're asked for your financial statements. Let's have a look at a couple of examples. Financial institutions like banks and other lending companies request them to decide whether to grant a loan or extend repayment terms. Vendors who are looking at giving credit to your business need to see how many other people you have bought on credit from and whether your business has enough cash to pay them on time. Government entities like SARS need financial statements to check the accuracy of taxes and other duties declared and paid by a company. Prospective investors make use of financial statements to see whether it will be worthwhile investing in your company. They may want to see how much debt you have or whether your monthly expenses are high, for example. You need financial statement information to make informed business decisions. Now let's look at each of the 3 documents so we can understand what unique perspective each one gives you of your business. The first document is the income statement. This is like the before photo of your business. It's like a picture of your business looking back in time. It tells the history of your business for a specific period. It's also often called a profit and loss or P&L statement. Another name for it is the income and expenditure statement. Perhaps those names give you a better idea of what it is. It lists all the income and expenditure of your business for a particular period. In a business, it's impossible to make a profit without spending some money. You have to incur costs or expenses in order to generate an income. This report shows you how much you had to spend in order to make a particular income. It also shows you the detail of what you had to spend it on in order to make that income. By detailing the sales and expenses of a company for a particular period, for example, a month or even a year, the income statement shows how much profit or loss the company made in that period. To understand how an income statement is set up, think of it as a set of stairs. You start at the top with the total amount of sales made during a particular period, and then you go down one step at a time. At each step, you make a deduction for certain costs or other operating expenses connected with making the sale. At the bottom of the stairs, after deducting all of the expenses, you learn how much the company actually earned or lost during that period. People often call this the bottom line. As you go down the stairs and deduct different classes of expenses, you'll encounter 3 different types of profit. These are referred to at different times and for different reasons. Gross profit is the amount remaining after deducting certain costs from your total income earned. These particular costs relate directly to making the product that was sold. So, for example, if you're manufacturing a product, these costs will be the raw materials that you use to make the product. An easy way to remember this type of profit is that the word gross means big or undivided. Net profit is the profit that is left over after all the other business expenses have been deducted. This includes things like rent, stationery, and salaries. Often, these expenses stay the same regardless of whether you make 1 or 100 sales. Net profit can also be called operating profit or profit before tax. Net profit after tax is the profit that is left over once you've deducted the tax that you owe SARS. As mentioned before, it's referred to as the bottom line. A common question by business owners is, why should I look at the income statement? The income statement is a useful document because it'll tell you at a glance whether you are making profit or not. Therefore, should you stay in business or should you change your strategy in some way? It'll show you if you're selling enough to cover the running costs or overheads of the business. If you're not selling enough, it'll guide you on setting new sales targets. By comparing individual expenses in your previous month's statements, you might identify areas where you are overspending. You'll use the information from the income statement to set future budgets. It'll help you to see if your business is worth all the effort that you've put into it. Are you, as the owner, really going to profit from all your hard work? If you're needing to make a purchase like a delivery van or a laptop, you'll be able to plan for this kind of spending by looking at your income statement. If you need funding for your business, the prospective lender will want to see whether your business is profitable. They may want to talk through with you how you can cut costs or increase sales in order to afford repayments. Your income statement will also show you how much tax the business has to pay. The second document that we'll look at is called the balance sheet. When you look in the mirror on any given day, you can properly assess where you're at with regards to your weight loss program. It gives you a snapshot on that day that you can use as a baseline for your behavior going forward. In the same way, a balance sheet provides a helpful snapshot of the business on a given day so that you can move forward strategically. What does the balance sheet show you? It shows you what you own and where you got the money to buy these assets. It shows if you borrowed a lot of money or put large sums of your personal money into the business to fund the buying. The balance sheet is a snapshot of a company on the specific day that is dated in the heading. It's not for a period of time. If I buy or sell a company asset tomorrow, the company's balance sheet will look different today than it will tomorrow. The balance sheet shows whether your business has many debts, and it'll show if you have the money to repay all the loans, the suppliers, and SARS. It shows if your business has a lot of cash in the bank, and if you should use some of it to expand your business by buying assets. Perhaps you pay a high rental and you should rather use your money to buy your own offices. Or perhaps you could buy bigger, better, or faster tools and equipment to produce more products. It shows if your customers owe you large sums of money, and if you should take some action to reduce this and bring in more cash to the business. It indicates which customers you could be more careful about allowing to buy on credit, or who you could encourage to pay you earlier by giving them an early payment discount. You could then focus on calling these clients more regularly to remind them of the outstanding balance on their account. When you look at the balance sheet, you'll see words that you may not be familiar with. Let's simplify some of this jargon. The first word we look at is asset. This is something that your business owns that has value to it. The types of assets are endless, but the common ones are your motor vehicles, your building, and your machinery or equipment that you use to make your products. It's also important to understand that an asset can be an intangible thing, such as money someone owes you. These are called debtors. The next word is liabilities. Liabilities show what your business owes to other people or companies or banks. Said in another way, it's what you're liable for. Another term that you'll come across on the balance sheet is the word current, which simply means now. The balance sheet reflects current assets and current liabilities. So from your understanding about assets and liabilities, which we have just discussed, current assets include both the tangible things and money people owe you now. These include your cash, stock, and the money owed to you. Current liabilities are what you owe people in other companies now or in the short term. It would make sense that if we're referring to the word current, that it implies that there are items on the balance sheet that are not current. Non-current basically means later or longer than a year. For example, the fact that I have a big expensive building won't help me if I owe someone money next month. It would take some time to sell the building in order to bring cash into my business. Therefore, non-current assets won't help me to pay current debt. Lastly, let's discuss owner's equity. This sounds confusing and is not a word many of us can easily relate to. This is really the money you as the owner have put into the company. You'll remember that you and your company are two separate legal entities, and so the money that you put into the company to get it started is owed to you by your business. This is just the same as when your business owes money to other companies such as banks. Therefore, owner's equity refers to the owner's personal money within the business and can also be referred to as shareholders' equity. You may have heard the equation A equals O plus L mentioned at some time. It's caused many brilliant entrepreneurs some serious confusion. This is the balancing part of the balance sheet. In very simple terms, this equation says that all the assets of the business were paid for or funded by owner's equity and the business's liabilities. So the value of the assets in the business will equal the total of all that the business owes to the owner and to other lenders. Lastly, we have the cash flow statement. The cash flow statement shows you exactly when money came into your business and what you spent it on. It has the same function in your business as a petrol gauge in your car. A petrol gauge tells you how much petrol you have in your tank. If you don't know how much petrol you have in your car's petrol tank, then you don't know how far you can drive. If you choose to drive somewhere without checking the level of petrol, then you can't be sure that you'll arrive at your destination. The cash flow statement is used in the same way. It's your business petrol gauge. If you know how much petrol you have, you can make informed decisions in your business well before they become a crisis.
Tom, have you had your petrol gauge fixed?
No, not yet. I ran out of petrol twice last month. You know how difficult it is driving around not knowing if you've got enough petrol to get to where you want to go to, and it happens every day. And especially sometimes when my wife uses the car and she doesn't tell me that she's filled up the car or not.
I really hope there's enough today, man. We can't afford to miss this meeting.
No, we should have enough. I put in 200 rand on my weight on last night. This whole thing, it kind of makes me feel like I do in business every day. We never really know our cash flow situation, right? I mean, we're guessing all the time. Sometimes I think that there's money there, and then when I go to draw, I realize that it's been used to cover an expense that, I don't even know was still outstanding. If we keep going on like this, we're going to come into some serious trouble one day in the future. We need some kind of easy system. Something that's as easy as looking at a working petrol gauge. Anyway, let's go. Get started. We're moving. Let's go.
Too many entrepreneurs find themselves stranded on the road with no petrol in their business tanks and are frantically looking for someone to supply them with a can of emergency cash at month end to make it to their destination. Managing your cash flow in a small business can often feel like you're navigating through very difficult and dangerous waters. You may need to cut your costs from the next quarter because you've just lost a big contract, or go on a sales drive to ensure you meet your minimum monthly costs. Without being able to look and plan ahead, you might find that there are some nasty surprises that you have not planned for. If a business has a negative cash flow over a period of time and the owners are unaware of it, they may get to the place where they'll lose the business. What is a negative cash flow? When the cash coming into the business is less than the cash going out, this is known as a negative cash flow. You can see that if this continues, the cash that the company has to use for the everyday operations gets less and less over a period of time. Left unchecked, this will lead to serious problems for the business and could even result in bankruptcy. Cash flow in the startup days of your business should be managed every day. It doesn't go away if you ignore it. You can't just get in a car, ignore the petrol gauge, and hope for the best. Because there's seldom extra cash available, decisions should not be made without considering the cash flow implications. Making poor decisions in this phase can be harder to recover from. What decisions are we talking about? It's not only purchasing decisions like, should I buy a piece of equipment this month or next month, but also things like your payment terms. If you have a job that is going to take a long time to complete, you should request a deposit upfront and then some milestone or monthly payments until the final payment is received once the work is completed to your customer's satisfaction. Salaries and bonuses. Can your business afford to expand by hiring extra staff right now? Are you in a position to pay your existing staff performance bonuses? If your tax is due in 3 months' time, will you have enough cash in the bank at that point, or will you need to increase sales or apply for a loan? It'll help you focus and streamline your management process by highlighting what worked and what didn't.